Joe LaGiglia, and welcome to the 2023 Mortgage Message forecast for housing and mortgage rates. Now, to set this up for you, we know that housing is so important. Housing is vital to all of us, and we've seen home prices come down just a little bit after soaring high. So what does 2023 have in store? Well, as we know with everything else, supply and demand will play a role, and impacting that demand will be where interest rates end up this year. As interest rates rose in the fall and early winter of 2022, we saw demand start to slow down, but interest rates have, at the end of 2022, started to show some signs of improvement, meaningful improvement, and I think that's going to continue into 2023, and I want to show you why. But before we get started, I want to identify who I had in mind specifically when I built this presentation. This presentation will speak directly to all the newer home buyers who bought a home in 2022 based on the motto, marry the house, date the rate. Good news, everyone. The time to break up with your mortgage rate is almost here, and I'm going to show you why. This presentation will also speak directly to all homeowners out there that for a multitude of reasons missed the window of listing their homes at the peak of the market before rates started to trend up. Your time to make that move is almost here, and I'm going to show you why. This presentation will most certainly speak to the first-time home buyer who's been hibernating, just waiting for rates to come down to more affordable levels in order to stop renting and start building wealth through home ownership. This is one of my favorite types of clients to work with, and I'm excited to share to the first-time home buyer watching that your time finally to make that leap is only a few months away. And I'm going to show you why. And lastly, this presentation is for anyone connected to the housing market, which is all of us. Whether you're a real estate agent, a property investor, or a family member or friend of a loved one looking to make a move in 2023, this timely information is to help you better understand how to advise the networks in your life in the coming months and year. So let's take a look at this together. I've got some very informative slides to share with you. And what I want to talk about first is how mortgage rates take their lead from inflation. The bottom line in pink is inflation. The top line is mortgage rates. And you can see historically that when inflation rises, mortgage rates rise. When inflation softens, mortgage rates soften. And when inflation goes flat, mortgage rates go flat. As an example right here, you got a little spike in inflation, boom, mortgage rates respond too. Now, we had a period here that the Fed, although their interest rate moves don't directly affect mortgage rates, the Fed were buying mortgage-backed securities, and that's going to have an impact. And the technical term for what the Fed was doing during this period is called quantitative easing, or QE. And during their period of QE, they kept mortgage rates right around 3% here. And you can see that. But as inflation started to rise from very low levels, near 1%, as that inflation started to rise, the Fed did think it was transitory, but mortgage rates didn't respond like they normally do. Why? Because the Fed kind of put a hold on it. The Fed was just buying enough mortgage bonds to tie them to that 3% rate. Now, once the Fed understood that inflation was in fact not transitory and that they were kind of behind on things, the mortgage rates started to move higher once the Fed stopped buying. Mortgage rates did what they always do. They followed inflation. So as inflation rose, mortgage rates rose. When inflation took a little bit of a reprieve, so did mortgage rates, as they moved lower with inflation. Then inflation started to move up, and sure enough, mortgage rates did as well. And as we've seen inflation come down at the end of 2022, mortgage rates have made some meaningful improvement, although they are significantly higher than where they were. So when we take a look at measuring inflation, we're going to look right now at the Consumer Price Index. There are a couple of different measurements. There's the Personal Consumption Expenditures, or the PCE, and then there's the CPI, or Consumer Price Index. Now, the CPI data may actually be more realistic for what's happening in inflation. But in addition to that, we get this data earlier, so it's a better measurement of forecasting. Now, when we take a look at the most recent numbers ending in 2022, the rate of inflation on the core CPI closing out of 2022 was at 6% on a year-over-year basis. So when we take a look at the most recent data that we received through November, If we take a look at each month's individual reading of inflation for the 12 most recent months, that's how you get to 6%. Now there's a little rounding and compounding there. So as we take a look moving forward, what we're going to start to do is replace these numbers here. You can see December of 2021 will be replaced with new numbers of 2022. And you could see the more recent data is showing reduced inflationary pressures. We know the economy is slowing. We know that we may be headed for a recession. So this should all mean that we'll see lower monthly inflation readings replace higher inflation readings that will now be taken out of the equation. So as we get December of 2022 replacing December of 2021, we should get a lower number, and that should bring our year-over-year inflation down. We should see the same thing in January, February, maybe not so much in March, but certainly April, May, and June, which is why we are thinking that inflation makes very meaningful improvements in the first half of 2023 as we get rid of these high readings and replace them with the lower readings. So when we replace the 2022 higher readings with the lower 2023 readings that should be ahead of us, that should help mortgage rates decline because mortgage rates follow inflation. Now, one other thing to take very important note of is the relationship between the U.S. 10-year Treasury, and that's illustrated in blue, and the 30-year fixed rate mortgage chart, and that's illustrated in yellow. Now, this compresses 35 years into one single chart. You can clearly see there's kind of a relationship between the two. It's not day to day, it's not exact, but there's kind of a range that this gravitates towards, and it's about 175 to 200 basis points, or in other words, 1.75% to 2%. So in the past, if the 10-year Treasury were, let's say, somewhere in the range of 4, then mortgage rates should be somewhere in the range of 6. And if the 10-year Treasury was at 5, mortgage rates should be somewhere in the range of 7. This has been going on relatively consistently for 35 years, until what we had seen towards the end of 2022, when the difference between the two of them was not 175 to 200 basis points, but 300 basis points. That's an enormous change in the spread. It was 3% higher. When you saw the 10-year Treasury a little over 4%, mortgage rates were a little over 7%. So why did we have that? If the normal range, let's call it, is 2%, and that range shot up to 3%, what happened that changed a consistent trend for the last 35 years? Well, you have to remember the value that goes into holding a mortgage. See, no one holds a mortgage on fixed rates. If you're making your payment to a company, you might think they're holding that mortgage, but they're not. That mortgage is sold in the secondary market. But what has to happen is someone still has to maintain the duties of collecting payments, telling you if you're late, answering your questions, taking that payment and making sure that taxes and insurance are paid. They have to service that mortgage. And that's why if you have a mortgage, you have a mortgage servicer. Now for doing that, for performing these tasks, the mortgage servicer receives a fee. So that adds value to the mortgage. And you could calculate a good estimate of that fee based upon how long you expect those fees to be out there. Now, under normal conditions, mortgages can last for years, several years, 4, 5, 6, 7 years for a mortgage before it's either paid off or refinanced. So you're going to collect that servicing fee for a long time. So that's a lot of value that's contained within that mortgage, and that added value helps the mortgage bond price, which helps to bring the rate down. Now follow me on this. When rates started to hit above 7%, everyone was thinking that these rates would not last and they will come down. The smart money was agreeing with the motto of 2022, which was marry the house, date the rate. So all the mortgage servicers and investors thought inflation would come down, which would bring rates down. And as mortgage rates anticipated to drop, that meant that servicing would not last because people would refinance or pay off their mortgages. They aren't going to keep those 7% mortgages for a long time, and the servicers knew it. And because of this, it sucked out all of the servicing value. And so instead of servicing value being measured in years as far as a revenue stream, it began to be measured in months, making that revenue stream much smaller and the value much less. and the component that went into the bonds price much lower, which meant the rates were moving higher in relation to the 10-year Treasury. Now, as the 10-year drops as I forecasted, and it goes lower and lower and lower, not only will mortgage rates drop, but they will drop faster as more servicing value gets added in. Because let's face it, a 6% mortgage will be on the books longer than a 7% mortgage, so there's more servicing value. Likewise, a 5% mortgage will be on the books longer than a 6% mortgage, so there's more servicing value. So it will accelerate its decline in more rapid fashion than the 10-year Treasury will. And we've already started to see this. As we closed out 2022, that spread was narrowing towards the end of the year as the 10-year Treasury moved closer to that 3.5, 3 5/8 rate. And mortgage rates already started to move into the low sixes. So that spread, which was about 300 basis points, has already narrowed to something closer to around 270 or 260 basis points. So we're seeing that happen already. And I do think that the 10-year Treasury gets around 3 or even less because of lower inflation, which means mortgage rates should follow suit. And if we do get the 10-year Treasury to 3%, we should start to get some more normal servicing values. And that means that I'm seeing mortgage rates closer to 5% around the first part of 2023, which will be huge for so many home buyers and homeowners. Now, we do think a recession is coming. And why this has been staved off, or if it's been staved off, here's the deal. The problem with knowing when you're in a recession is we have to wait until the National Bureau of Economic Research declares we're in a recession. But they don't typically make that announcement until a year after we're already in it. We're typically through or on our way out of a recession before we even know we were in one. It doesn't really do us a lot of help, but what you can see here is that there's already signs. Take a look at the credit card debt. We are, after stimulus, living on credit cards for many people and also tapping into savings. These bumps right here are the 3 stimulus packages that help people with savings. But that's been all drained out. And we are even moving much lower than pre-COVID levels. So people are keeping a lifestyle, but they're using credit cards and savings to maintain it. Even this has an expiration date and limitations on it. And when that hits a brick wall, the recession will become evident. Now, we know that there are also signs that are proving to be important signs, like yield curve inversion. This is when you take longer maturities that are supposed to have a higher rate of interest, but actually yield a lower rate of interest than their shorter term counterparts. And it's a very reliable indicator when you take the 10-year Treasury and you subtract it from the 3-month Treasury. Now, the 10-year is supposed to be higher than the 3-month, so a bigger number minus a smaller number should be positive. But the yield on the 3-month Treasury is actually higher than the 10-year. So you take the 10-year minus the 3-month, you're getting a negative number. And when that happens, which here's the zero line, negative, recession, negative, recession, negative, recession, negative, recession. And we are very negative here. So we are either right on the cusp or in or about to head into a recession. And you can even see the last one here. It was awfully close before the recession. So this is a very reliable indicator of recessions. And remember, folks, during recessions, mortgage rates decline. So let's shift our focus to housing. And one of the most important aspects of housing is supply and demand. Now, the demand will come from household formations. And we've been chugging along forming households at a rate of about 1.7 million a year. And this is where you have a family member who's living in a home, let's say it's one of the children that comes of age, and they move out and they get their own place. So it's still the same family unit, but now they're occupying an additional household. That's a household formation. We've been chugging along at roughly 1.7 million for a while. But as we saw mortgage rates get to over 7%, some of those people that were going to form households went into a bit of a hibernation, waiting for rates to come down. So this is kind of a pent-up demand right here. And now at the same time, supply is softer. Builders have slowed things down. They're completing about 1.5 million homes. But yet, there's about 100,000 homes every year that have to be replaced because of aging. So we're really only seeing about 1.4 million homes come on the market. And currently, with that hibernation, we're at about 1.3 million households forming. So that's why the housing market has slowed for now in activity. But when these rates come back down, you're going to have household formations go back to its normal rate of about 1.7 million, and that will overwhelm the supply. And that should be very supportive of prices. And builders have slowed things down. Permits have slowed. They've learned their lesson from the housing crash in 2006 to 2009. And while people want to say it's a housing crash we're in, that's hardly the case. Look, in the last 10 years, prices are up 115%. In the last couple of years, they're up 39%. Now, even with rates at 7%, we've seen them come in a little bit, down about 2.5%, but not very much, even with the headwinds of much higher rates. And the reason for that is because inventory is still very light, and competing rents are still pretty high. People want to buy homes, but they're just hibernating for a bit. But remember, when these rates come down, things will change. So my housing forecast for 2023 shows low single-digit appreciation for most of the U.S., with a pickup in activity. And reasons for this is because of lower inflation. We've got recession-like slowdown happening. We've got incomes increasing to help affordability, and a very tight inventory environment. And rents are still expensive and rising, not giving people much of an alternative. So I see appreciation for most of the U.S. and an increase in activity. Now for my mortgage rate forecast for 2023, let's look at some of the headwinds first. There is global quantitative tightening, so money is getting tighter. There's a lack of foreign central bank buying, and we know that. So these can be headwinds. And look, there's still a lot of debt out there that's got to be financed too. But let's talk about our tailwinds. Number one, lower inflation. Retail goods inventory is building to record levels, and that means there will be sales driving down prices. Mortgage servicing value has increased, and there's likely going to be a recession where rates will decline. So I see 30-year fixed mortgage rates moving near 5% during the first half of 2023, and the 10-year Treasury near 3% or lower. I actually believe that it'll go lower than 3%. So what do you do now with this information? My hope is that you share it with people in your life that can greatly benefit from it. The family that married the home and dated the rate last year, the homeowner that's been waiting for the perfect time to list their home and upgrade to a bigger one, the first-time home buyer that cannot wait to get a place of their own. Share this presentation with anyone you know that can gain value from forecasting the year ahead in housing and mortgage rates. They'll be glad you did it. So there you have it. My 2023 forecast has officially been released, and I think there's good news ahead. I believe that there's reason for optimism as we look ahead to 2023. And as we look ahead, my lending team and I are here to help you navigate through this exciting changing market to best position you and your family in 2023 and beyond. For myself and my entire team, we want to wish you health, happiness, and prosperity in the year ahead. This is Joe LaGiglia with Mortgage Message, wishing you your very best year yet. Thank you.